Are you ready to make smart investment decisions in 2023? In today's episode, we're going to reveal the top assets to consider adding to your portfolio this year. So stay tuned to discover how you can grow your wealth and secure your financial future. But before we continue with today's episode, just a disclaimer, I'd like to take a moment to just let you know that keep in mind that any stock or financial advice mentioned in this show is for informational and educational purposes only. I am not a professional financial advisor. The information that you're about to hear should not be considered as professional advice. Let's go. All right, welcome to the Common Sense Show, where we help you make sense of personal finance, investments, assetizing your business, and everything in between so that you can win back time, gain leverage, and live life on your own terms. I'm Micah, and today we're just exploring some of the best assets that you can invest in for this year. Now, I know that we are in April, almost in May, and so almost half the year has gone by, but it's never too late to begin investing for the year. Now, whether you're a seasoned investor or just starting out, today's episode is going to give you some valuable insights into to make some informed decisions. So we're just going to get right into it. So before we delve into the top assets for 2023, I just want to do a broad sweep and just lay out the lay of the land about what different types of assets are available to you to actually invest in. So we're going to go over 5 of them. So the first one is stocks. And you may have heard the term stocks. You probably have purchased stocks before. But just to give a brief overview of what stocks are also known as equities. So sometimes if you're watching CNBC or another program, they might say equities instead of stocks. But that word is interchangeable. And basically what stocks represent is ownership in a company, and they can offer you the potential for 2 things: capital gains and dividends. What are capital gains? Capital gains are when you purchase a stock for $30 and the stock goes up to $60 and then you sell it. Once you sell it at $60 and you've made $30, those are capital gains and you're taxed at that point. But remember, an increase in stock price or a decrease in stock price means that your net worth has gone up or down, technically because that stock value has gone up or down, but it's not true realized income yet because you only realize income or losses only after you sell the stock. So if you sold the stock for a loss, at that point, that's when you would lose. If you sold the stock for a gain, at that point, that's when you win, and that's when you get taxed. Another thing that stocks can offer you, in addition to the increase in the equity price, is dividends. So there are some stocks that offer you both capital gains and dividends. One of the dividend stocks that I like well, 2 of them are Bank of America, JP Morgan. They offer you both increases in capital gains, but they also offer dividend payouts. And one thing that you should know about stock payouts is that they pay out at different schedules. So some companies pay their dividends to their shareholders on a monthly basis, some pay quarterly. So depending on how many shares you buy, you could do the math based off of the previous history of how much a company actually pays out in stocks to try to figure out how much you would get based off of how much money you put in. And then if you want to try to get monthly income versus quarterly income, that's when you would choose a stock for monthly income versus quarterly income. Another asset that you might consider adding to your portfolio are bonds. Now, I know with the news of SVB, Silicon Valley Bank, going belly up, and part of the reason why is when the Fed increased their inflation rates and it depressed the bond market, it caused them to lose money. It does not mean that all bonds are bad, but let's just talk about what bonds are. So bonds are fixed income investments that pay interest over time and typically have a lower risk compared to stocks. So stocks typically move on a daily basis. Heck, they move on an hourly basis. And so you might check your stock portfolio, and at 12 o'clock noon, it's at, let's say, $63 a share. And then let's say the CEO has a scandal, or the CEO dies, or the CEO gets sick, and they don't know who's going to take over. Then that share price could plummet down to like 51 in the next hour when that news breaks. So that's how volatile stocks are. But in terms of bonds, they're a lot more stable than equities, than stocks. They're a lot more steady. They climb slower in terms of capital gains, which is the reason why people invest in bonds instead of stocks if they're becoming more conservative for reasons of retirement and switching to something more conservative, or reasons where they have excess cash and they don't want to lose it. So they invest in bonds because they know that it's a slow roll to getting more money. Another asset that you can invest in 2023 is real estate. Property investments can provide you with rental income, with tax benefits if you need a tax break, with potential appreciation because the actual price of the house has gone up, and now you bought it for $300,000 and now it's worth $350,000, and you can get money that way. So in terms of increasing the value of that asset, real estate is very much like an equity where it can go up in price, and your quote dividend could be like your rental income that you get from the property. So what you may have not noticed here is that the house you live in, and now there's a hot debate about whether the house you live in is actually considered an asset. You talk to people like Grant Cardone or Robert Kiyosaki, they don't believe that the house you live in is actually an asset because it does not pay you, and you have liabilities at risk that you have to continue to pay every month, and you have to earn income to pay all the bills that you're living in monthly versus it generating cash for you. So you can figure that out on your own. The fourth thing that you can invest in 2023 is cryptocurrency. Now, I understand that you may not know a lot about cryptocurrency, but it's worth kind of knowing the basics. So what cryptocurrency is are digital currencies. So imagine your dollar, but turned into the digital currency like Bitcoin or Ethereum. And those have been gaining steam as popular alternative investments with potential high returns. You probably heard a lot of stories that there's been a lot of Bitcoin millionaire and billionaires made because initially Bitcoin was something like, I don't know, 10 cents, 50 cents a dollar. And now Bitcoin is trading in the tens of thousands of dollars. I think it was like maybe 16 to 20,000 the last time I looked. I'm not exactly sure what it is today, but the reality is that that made a lot of people a lot of money. And the last one is commodities. So investments in natural resources such as gold, silver, and oil can help diversify your portfolio and hedge against inflation. Precious metals are time-tested investments, and a lot of people invest in them because, again, just like equities, those stocks, the prices of gold and silver go up and down with the times. And, frankly, when people feel like everything goes to crap, the first thing they do is they buy silver and gold. Before we reveal the best assets for 2023, I want to share an exciting opportunity for you, though. If you're committed to taking control of your financial destiny, consider joining the Common Sense Council, which is our exclusive business coaching program. You'll gain access to expert guidance, resources, and a supportive community to help you achieve your financial goals. Visit our website to learn more and sign up for the Common Sense Council today. That is www.thecommonsensepodcast.com. Now, let's discuss the top assets to invest in for 2023. Now that we've covered the basics of what those assets are, let's explore the best assets to consider having specifically and investing in 2023. So we talked about stocks initially. One of the stocks that you can consider investing in are what's called blue chip stocks. Now, blue chip stocks are companies with a strong record of performance and stable earnings that can offer both growth and income. So the growth in terms of the equity going up in value and the potential income in the form of dividends. So one of the stable blue chip stocks and companies currently are companies like Apple, Coca-Cola, Pepsi, the companies that you think of that are really, really big and have generations of income that they actually provided for people like Warren Buffett, who was a early investor in Coca-Cola, and it has paid huge dividends for him. Now, what kind of income potential can those stocks give you? Well, stocks like JP Morgan, as I mentioned, in Bank of America, even though there's a bit of a financial banking crisis going on, those stocks tend to still perform very well and pay dividends even in unstable markets. So I think that if you're looking at a ratio of dividends coming out, you need to figure out how much you can reverse engineer this problem, how much money you need to invest in order to get how much money you want out. So let's say that you wanted to get, call it $3,000 of income a month in dividends from stocks. You have to do the math, how much money you need to invest into stocks based off of what their predicted dividend returns are going to be, and then you can do the math on that and figure out, well, how many shares do you need that will yield you $3,000 a month. It's probably going to be a significant investment. Depending on what the stock price is, you'll have to just do that. You can go ahead and read the stock information. If you go to Vanguard, E-Trade, if you go to Yahoo Finance, a lot of different stock websites will give you the prospectus and the earnings statements, because all these public companies have to report the earnings, so you'll be able to see what they're doing. Another stock that you can choose are green energy stocks. With a global shift towards renewables, companies around the world in this sector have seen significant growth prospects. Governments are funding renewable energy initiatives, especially in the United States, in Germany, in France. And they're not all great in terms of being able to deliver the renewables at a high level right now. In some cases, they are typically smaller villages and smaller cities, because they can monitor it better. And if if the temperature is fairly stable in a climate and an environment, then your chances of the renewables not being as successful go down. So think about the location, think about an area where perhaps this renewable energy company would have stable weather and potential to deliver results and income back to the shareholders. So another thing that you can invest in, we talked about bonds. Now here's a specific bond that you can buy. You can buy emerging market bonds. And what those are, typically bonds that were issued that offer a high yield. So normally when there are high yield bonds that are issued, the percentage that they pay back when they mature, like a loan, goes up. And so they make a promise to pay you at a certain percentage when the bond matures, and at the end you get your cash back. But they do have high yield bonds in markets that are slowly getting stronger. So you want to consider where in the world you might be able to find some nice high yield emerging market bonds that will pay you a big percentage. You want to look at the maturity date, and you want to look at the percentage that they're paying out. Now, if the maturity date is in 15 years, you may say to yourself, well, I don't want to wait 15 years to earn 4%, 5%, or 6% on a high yield bond. So you may consider maybe purchasing a bond with a maturity date closer to when you're going to invest 2023. Maybe you say, okay, well, 2027 is perfectly fine for me, but that's up to you. Now, real estate investments. Real estate investments, you can do a couple things today. So you don't have to own specific properties in order to own real estate. If you're watching this and you're a beginning investor, there are these things called REITs. REITs stand for Real Estate Investment Trust. And REITs can provide exposure to real estate with the added benefits of liquidity and diversification. You can buy into a REIT, which basically what a REIT is it's an equity that has baskets of real estate properties that a company goes out, creates a real estate fund. They go out and purchase all these real estate properties. Could be residential, like multifamilies. It could be commercial. And oftentimes they invest because they're experienced in managing real estate assets. And they put all of these assets into one big bucket. And then they create one fund, which they call a REIT. You can invest in that, so you own a piece of the real estate without actually owning the real estate. Your investment obviously gives them capital to go out and deploy it and buy more and return more money back to the REIT. So there's that. The other thing is that what you should realize is that REITs also are subject to the market, the real estate market, and what's going on. So you have to think about whether or not you want to be part of a REIT, and does this REIT have a history, a track record of returns to investors. Now, if you're going to invest in a commercial real estate REIT, just remember that if this REIT contains perhaps real estate that is like a bunch of malls are taking a hit right now. across America. Sears is closing. Macy's is not what it used to be. There's a lot of stores that have gone out of business over the years. And part of that means that you have to kind of just take a look at where the real estate market is and what it is returning back to you. Perhaps you may want to invest in a commercial real estate REIT that has, for instance, things like businesses like Dollar Tree in there, because Dollar Trees are typically recession resistant, right? Dollar stores are recession resistant. Walmart is fairly recession resistant. So people still shop at these stores, and that means that these landlords are always getting their money, which means that they're returning money because people are shopping at these places. Always look for real estate REITs, commercial REITs that contain properties that actually are fairly recession proof. Look at businesses that are fairly recession proof. Now let's talk about cryptocurrencies. Now consider investing in well-established cryptocurrencies with strong fundamentals and real-world use cases. Now there's so many people developing their own coins today, and those are called basically crap coins because they're nonsense. But there are a lot of stable coins in crypto. Now, cryptos that are already being used for currency exchanging on a large level are typically good cryptos to engage in. So things, as we mentioned before, Bitcoin, Ethereum are good companies to use. Now, some companies use the science behind cryptocurrency, the security behind cryptocurrency, which is blockchain technology. And so look for cryptocurrencies or companies that are using blockchain technology for like supply chain management or smart contracts like Ethereum, which supports the creation and execution of smart contracts. And smart contracts, Gary Vee said, smart contracts are the wave of the future. So if you like Gary Vee, if you think he has a finger on the pulse of, what assets are coming up, then you may want to look at that. Now, smart contracts are also self-executing because typically what they do is they put the language in there in the contract, how far they're willing to go on either side, and then both sides execute it after they simply agree to what the terms are in the agreement. So it makes them fairly flexible. Now, before we give you some success tips for investing in 2023, I just want to ask you, if you're looking for a place to connect with other investors and discuss the latest investment trends, you need to join our Locals community. It's an engaging platform where subscribers, viewers like you, or people who are listening to the podcast like you, of the Common Sense Show can come together and talk about personal finance, business, investing, all of it. To join, all you have to do is visit our Locals page, commonsenseshow.locals.com, and sign up there to become a supporter of the show. So we look forward to seeing you there. Now, to wrap up, here are some tips so that you can be successful in 2023, because I gave you a ton of stuff today. Number one, diversify. You want to spread your investments across different asset classes. Remember, an asset class is simply the vehicle you choose to invest in: stocks, real estate, bonds, okay? To reduce risk. You don't want all your money in stocks. You don't want all your money in bonds. You don't want all your money in crypto. You need to spread it out, because when something is up, something else is going to be down. You want to balance it out. So just be careful, for goodness sake. Number two, stay informed. Keep up with market news, trends, and analysis to make informed decisions. Like, you have to actually turn on financial news so that you can see what's going on. Remember, your gut calls based off of what's going on maybe in a company, if someone's doing something, are probably just as good as the expert gut calls, because people on CNBC, the talking heads that talk about finance all the time, those people are just making gut calls based off of what they see. So if you see a management team seeming like they're mismanaging a company, if you see that a company is actually making specific moves and you want to try to ride the wave before the stock goes up because you've heard some rumors, then go ahead and do it if you feel like that's the right move. But what you shouldn't do is you shouldn't listen to people who are talking heads and just make decisions based off of what they say, because you never know what their incentive are. You have two eyes to look to see what's going on, two ears to listen to see what's going on. So use them both and use your common sense. If a company seems like it's trying to do the right thing, see what their financials are, learn how to read a financial statement like a asset a asset statement or a P&L so that you can see how much money they have coming in and if they really are in a position to do what they say they're going to do. Focus on your long-term goals. What are your goals? You need to establish some. So establish some goals for yourself so that you can have a long-term perspective in mind because stocks are going to go up and down. Some of the assets, the equities, all those things, these are going to go up and down. So you need to have balls of steel essentially in order to be able to get to the other side and avoid making impulsive decisions like you see your stock going down, you want to sell it because you don't know what's going on. But if you just hold on to it, after the '08 crisis, some of the wealthiest people in the world were people who held on to their stocks and didn't sell them because the market came screaming back in the years subsequently to follow. And the last thing is to practice risk management. So set realistic targets for which you want to earn, what your goals are, have those in mind so that you know when to come out. All right. So you know when you can move on to another investment and always be on the lookout for things that you can invest in, values that can go up over time. And they should always be things that you can calculate prior to getting in. Two micro rules of investing from the Common Sense Show are this: never invest in things that you don't know about. Never invest in things that you don't believe in. If you follow those rules, I think you'll be okay. But remember, this is not financial advice. This is informational, educational only. To close out, if you don't go to work on your business, personal business, or your actual business, then you're going to go to work on building the business and the knowledge base for someone else. I'm Micah, and I'm out of here. Take care.